Money measurement concept is an important accounting concept that is based on the theory that a company should be recording only those transactions that can be measured or expressed in monetary terms on the financial statement, also known as measurability concept, which states that during the recording of an financial transaction, two transactions should not be recorded which cannot be expressed in terms of monetary value.
Next is the periodicity concept. The periodicity concept in accounting means breaking down a business financial activities into regular time periods like monthly, quarterly, or yearly. This helps in creating timely and understandable financial statements that show how the business is doing over time. It allows stakeholders to track performance and make informed decisions. For an example, let's say you own a small retail store. At the end of each month, you gather all your sales and expense records for that month and compile them into a financial statement. This statement shows how much revenue your store made, how much it spent on expenses like rent and inventory, and what the profit or loss was for that month. By doing this monthly, you're applying the periodicity concept. It helps you see how your store is performing over time and lets you make adjustments or decisions based on that information. Thank you.
For the next concept is the objectivity concept. The objectivity concept in accounting is a fundamental principle that emphasizes the need for financial information to be reliable, verifiable, and free from bias. This concept ensures that financial statement accurately reflects the economic reality of entity, transaction, and event. For example, by adhering to the objectivity concept, accounting practice aim to enhance the credibilities, trustworthiness of financial information, fostering transparency and accountability in the reporting of an organization's financial performance.
So the last one is the consistency concept. Consistency concept is a company's financial statements follow the same accounting principle, procedures, practices, and methods from one accounting period to the next. Change are permitted only when the new method is considered better and can reflect the true and a fair view of the financial of the company. The change and its effect on profits should be disclosed in the financial statements. For example, imagine you own a bakery and you have been using one way to figure out how much your ovens lose value each year. It's like saying, every year my oven lose 1/10 of their value. Now if you suddenly decide to change the way you figure this out, it can confuse people. It is like, one year you say my oven lose 1/5 of their value, and the next year you say no, they lose 1/8 of their value. But if you stick to the same way every year, it helps people understand better. They can compare how your bakery is doing from one year to the next year without getting mixed up. This consistency makes it easier for them to trust your financial reports and make smart decisions. That's all. Thank you. So the first accounting process is a source documents. Source documents is an original records of financials such as invoice and receipt. The second one is books of prime entry. Books of prime entry is our initial records where transactions are first entered. Examples include the day book, purchase day book, and cash book.
The third step is ledger. It refers to a book that contains different accounts where records of transactions pertaining to a specific account is stored. It is also known as a book of final entry or principal book of accounts. It is a book where all transactions either debited or credited are stored for its trial balance. This is a financial report of credit entries and debit entries that businesses use to internally audit their double entry accounting system. The goal is to confirm that the sum of all debits equals the sum of all credits and identify whether any entries have been recorded in the wrong account. That's all from me.
The fifth one, adjustment. Adjustment are changes we make to update account balance before we create financial statement. We make these changes to match up the money we earn and spend with the right time period. The sixth one, adjusted trial balance. An adjusted trial balance is a list that shows all the account balance after we made adjustment. It shows the correct amount of money in all our account and we use it to make sure our accounting records are balanced and accurate.
Next is financial statements. It is document that show the financial health of a business or organization. There are three main types of financial statements, which is income statement, balance sheet, and cash flow statement. The last step is closing entries. So closing entries are the final step in the accounting cycle that help prepare a company's books for the start of new accounting period. These entries involve transferring the balance of temporary accounts such as revenue, expenses, and dividends to the permanent accounts on the balance sheet. Thank you.
Next, we will be moving on to question 2. There are three documents that we have prepared. This is an invoice document. The explanation for this document is City Comtech sold goods to Majujaya Enterprise on credit amounting to Rm 6,300 on 3 June 2024.
Next is check but for rental payment. The explanation for this document is City Comtech pay Abu for shop rental on check amounting 1,400 ringgit on 31 June 2024.
The third document is memo for drawing. The explanation for this is owner of City Common Tech took goods amounting 55 ringgit for personal use on 28 June 2024.
Moving on, now I will demonstrate the preparation of the book of prime entry. As you can see in the slide, there's two examples of source document. The first is invoice issued, which is sales, and the second one is invoice received, which is purchase. The explanation is for the sales is that City Comtech sold goods to BB Super SDN BHD on credit amounting Rm 14,150 on 9 June 2024. For the purchase is City Comtech purchased goods from T Supply SDN BHD on credit amounting Rm 5,000 on 10 June 2024. Now let's see how we will transfer this information to the book of prime entry. This is how you would record this transaction. The first example is for the sales journal. So the customer is BB Super Sendirian Berhad and account debited is on account receivable, which BB Super owes to us and we expect to receive money from BB Super in the future. And for the example number 2 is purchase journal. The supplier that we work with is T Supply Sendirian Berhad. The account credited is on account payable, which we owe to T Supplies that we need to pay in the future because it is on credit.
As for receive and voucher document, I will explain how the transactions are recorded in the book of prime entry. For example 1, City Comtech received payment from Jane Smith on check amounting Rm 500 on 2 April 2024. For example 2, City Comtech make a payment to Sam Smith on check amounting Rm 1,000 on 1 May 2024. Here is how you would record the transaction in the book of prime entry. For the first example is cash receipt journal. As you can see, the customer is Jane Smith, paying receipt number 100. For account debited is cash or bank amounting Rm 500. For example 2 is cash purchase journal. That description is ran for the month of May, which is payment number 101, and account debited is ran expenses.